All right. Good morning, everybody. What a day, huh? We don't have the AM edition yet of Spot Gamma, but looking at their PM edition, they did suggest today we would see a dead cat bounce. Remember that? I might share it in the morning, but it was published yesterday, right? That came out after the close. And sure, we're up a little bit this morning, not by much. We're going to get a little bit of job numbers this morning. Anything connected to jobs, something that you want to pay particular attention to. But these aren't the big job numbers. And later in the week, we're going to get more job numbers. This is just like the first punch. It's the JOLTS data. I like the way I was taught to think of JOLTS is the take this job and shove it numbers. How easy you think it would be to leave the job you have and go find a different job comparable or better than the one that you have. The grass is greener concept. We can see that this one has a little bit of impact on the meter, meaning it in the past, it has caused some volatility. Doesn't mean it will today, just that it has in the past. Then we have some auctions today as well. There was news today that Trump's going to meet with US CEOs. This is tied back to all the money that's leaving the US, and not just from US traders either. Markets around the world trade in the US, but with our economic policies and corporations saying in earnings that they can't give a good outlook because there's so much uncertainty, money is flowing into other nations where policy is still intact. Things haven't changed all that much. It's got a consistent, EPS and GDP ratio. So it looks like they're trying to maybe tamp down on some of that uncertainty. We'll see. It wasn't given a time frame, just says he's supposed to meet with him, but don't see a time frame on it. That came out on Finance Juice, by the way. If we just click that link, it would take us over to the Europe wrap. If you look at where we're at this morning and you measure just the RTH of yesterday, not all of yesterday, right? Not the Globex, just the regular trading hours. You can see that we've rallied up and we're fighting with the midpoint. Seems like we're finally getting through it now, but that's where we were stuck. If we can get through that, then we can work on getting back up to yesterday's RTH high. And then, of course, if we can get through that, then we're working on getting to the high of yesterday, which is really close to the 3-week moving average. We have a voodoo line of concern, 5683. It's the snow line. And the call wall was moved to the upside a couple of hundred points. So the way that I've been sharing the call wall in a picture seems to be helping people out. Remember, I used to just share today's. Now I do it side by side. I didn't think I needed to do this because I share it every day. You could just go back on your own and look at yesterday's without me having to do this, but it seems to help people. So we can see the call wall yesterday was at 6,200. It's at 65 now. They rolled it up. That is considered bullish. It's a bullish bias to see that happen. On the other side, though, the put wall was at 57 and now it's at 55. So they rolled the put wall down. They rolled the call wall up. It's like they gave us a wider range. And we have to keep in mind that this is OPEX, right? This is the week for options expiration. No, excuse me, we got one more week. I misspoke. It's next week. This week is where we're going to leave the futures contract that we're on and go to the next one. Because then usually in the last week of trading, we're already on the new contract series. So we still have 2 weeks of options. It's very likely they're just giving us some room, but to me, it seems like they just gave us a range, a 1,000 point range from 65 to 55. We'll see what we can do with it. Zero gamma and volatility trigger is above the 10-week, the 10-day, the 20-day. We got all these moving averages overhead, the 3-week, all of those. We got to get through all of them if we're going to get to zero gamma and the volatility trigger. With the really big moves that we saw yesterday, this ADR looks really small in comparison. It doesn't look like it would take much for us to hit either side. And depending on when you start the drawing, you can see how these sort of started around midnight or after midnight. If we had started them at 6 o'clock last night when we got opened up, we've already hit the lower edge. So it's just a visual. The distance that we see here and even the locations of it are based on 6 o'clock when it opened. So if that's true, then the line visually is missing. It should already be extended out there. So we hit the lower edge. If we hit one side early enough, we can hit the other side by the end of the day. Well, early enough, we hit that yesterday in late after hours trading. So sure, we can hit the other edge by the end of the day. We could even overshoot it and get into the full ADR. And yeah, we can overshoot that and get into yesterday's high. Nothing so far says that we're done. We haven't got any clarity on tariffs. We haven't got any forward outlook on policy. We don't even have the government funded. So nothing has changed. And since nothing has changed, we're not going to just, get a miracle and come rallying back out of these lows, because what put us down here isn't gone. Looking at the floor pivots for today, it's at this point seems destined to hit this floor pivot. There's an 80% chance we're going to hit that purple line, but then what? If we don't hit it, it's an MDP for tomorrow. It wouldn't count for today. And it really does seem like we're going to hit it. So we need to hit it, get above it, then focus on the RTH levels that we've already discussed. Today's pivot is lower than yesterday's. That's bearish. Price opened underneath it, and that's also bearish. Going up and hitting the pivot is not considered bullish at this point. This is like nature and a reaction to stimulus. Say you throw a ball in the air, what do you expect? It comes back down. because that's the way science works. Going back towards this pivot is not bullish. It's just a function of reaction. So we won't consider a bullish bias until we get above it and say challenge the R1 and get above that. So don't take this upside move this morning as some, bullish reaction. Just like last week, so far this week, we have a really wide profile without a lot of insight other than we are at the point of control. We were talking about yesterday's half back and how we were stuck there. And that lines up with this point of control that we've built out. When I was looking at this last night, it was lower down around the 5630 area, the cog line. So holding this morning around that halfback finally brought it up a little more. But there's nothing of note here since it's just so wide and it's just a really big distribution. It is worth noting that we're below the 200-day moving average. And we are below that 5,700. I had been mentioning if we broke that 5,700 that we could, really break down fast. Ed Yardeni, which is an analyst that's been around longer than I've been alive, says that 5,600 is his line in the sand, and it might have been 5,550. Really, been a while since I read it, so if I misquote him, that's on me. It was either 5,600 or 5,500, 5,550. But his lower line in the sand hasn't been broke yet. So his call for a flash crash is below that line. And when an analyst gives that kind of level, like swag levels that we've talked about before, those levels can get changed based on how close we get to it and how long it took to get to that line. We use that a lot when it comes to, say, dollar and yields, right? We'll have a line like 4.5 and we'll say, well, okay, well, if we get to 4.5 and we get below it, we'll see this sort of reaction. But then it might take 2 weeks to actually get to 4.5. And at that point, well, the line has moved. And we say, okay, well, if we get to 4.2 and we get below it, we'll see this sort of reaction. So those levels, they have a time to them, right? Like an expiration to them. And how long it takes for us to get there matters. At this point, does Yardeni still have that 5,600 or that 5,550? I don't know, right? I'm not one of his subscribers. I don't follow the guy. I'd rather just do my own work. I just know his levels because it was something that was pointed out to me. We don't have to worry about 5,700 as a level to get below because, well, we're already below it. At this point, 5,500 does make sense. But whether that will be a catalyst for a flash crash, it's going to take more work than we've got time for this morning. We still got pretty good volume coming in at 158 in the overnight hours. Generally speaking, we don't want to see this get below, say, 48 to 50. And generally it stays below 100. But looking back, we've been hitting above 100 in the overnight hours day after day after day. So we're getting a lot of players participating. I'd say it's been quite a while since February 27th when we didn't have overnight volume above 100,000. 10-day, 30-minute volume profile with TPO, we're going to start taking out the candles that built the point of control where it is right now. So it's very likely we're going to see that move, and 57.75 is likely where it ends up, somewhere around this area, around the middle of the chart. Obviously, that's over our heads, so any move to the upside is going to have to get through that point eventually. We hit an old VPOC level yesterday. From last year, very likely from the start of the contract that we're on, this March contract. We don't have a new VPOC to line up. And so far this morning, the volume that we've been building against that halfback has been greater than at any other location last night, because that's where our point of control is. It's a little difficult to see, but this is a P-shape profile this morning. It'd be a little cleaner if it wasn't so broad here in the middle, but that's a P-shaped profile with a distribution across the top. So like we ran up and found all of this up here, and we don't know if it's done yet. We got to continue to absorb and see if we can get through it. It's interesting to note, however, that we haven't sold off from it after getting here. Looking at the weekly expected move, we are outside the box, but we have an expectation of closing within this range by the end of the week. That's what we do, and it's what we expect to do 70% of the time. Because it's the S&P, we generally do it 80% of the time. But that would be the base case argument, is that we close inside this range. We could take a look at last week. We did not close inside the range. And in fact, we can measure, it looked like we closed an entire deviation lower, plus some. Okay, we came back in it, but just barely. We are 4.5% below the 10-week moving average, and we are due for some sort of turnaround and mean reversion. You can see the last time we got this deep, and by the end of the next candle, we were above the 10-week. That is a really big change really fast. We went from being below the 10 more than 4% to above the 10 in a single shot. Nice follow through too. So it's likely that we could see something similar. If you look at the advanced sell-off, how fast we fell back here, how far below the 10 we were, and the strength of that move back in the other direction. Now, make no mistake about it, we might have corrected and ran all the way up in that example and continued on, but that's not what we're expecting here. A mean reversion? Sure, why not? Dead cat bounce? Possibly. But I wouldn't expect this follow through, because we've got too much uncertainty. We got too much change in policy and structure, and we're not going to start a new earnings cycle for a while. We're going to continue to hear from companies in this cycle who have nothing to say about their forward outlook that makes people want to stay here and put money in the market. If you're looking for an upside target on some cheap lotteries, aim for the 10-week. Try to buy some options if they're cheap enough around that 10-week. It doesn't have to get there in a single shot like I showed you back here. We've got other examples where we got this steep and we stayed down there for a while. Of course, this area back here is from the 2022 bear market too. Looking at the 10-day, we're more than 2.5% below the 10-day. The idea is we'll begin to mean revert back the other direction. It could be that we go back to the 10 and cross above it, but it doesn't owe us that, especially in a single shot. We've certainly got examples back here where we were below the 2, and it took a few days, but we managed to run back up and get through relatively quickly. But then there's been others where we just stay down here for a while. And we've already been down here. We've been below the 10 since the last week in February. So sure, it looks like we're going to get a bounce. We're a little oversold, although I don't like the phrase. We've moved swiftly in one direction far enough that it very likely causes a bounce and we go back in the other direction. Just don't mistake that for any sort of recovery or with any idea that it's all over now and we're going to go back up again. I've got a piece that I'm working on that takes into account the framework we had that we're transitioning out of and the framework that they're trying to put into place. And we don't get much in the market that's new, right? Usually we've seen it before. And this is no exception. There's been periods in history where a new administration comes in and they change the framework from one system to another system, even like what we're going through now. I'm not done with my piece yet, still putting it together. But the last time we transitioned like this, the markets went down over 25% before it finally washed out the old system and started pricing in the new system. Just for a frame of reference, right? We're not even down 10, or maybe we're around 10. And we went down more than 25 last time. So the old phrase, know what you own, get comfortable with it. Looking at things over a 5-day period, we can see that we're starting to get a little bit of green on the screen. A couple of sectors that are at least back into the 0 area. Just because over the last week, we've seen some of those getting a bounce, like utilities bounced on that 200 period moving average. Or industrials at least found some support on the 200. But we've got others that are completely below it and pointing lower, or that are rallying back up and are about to hit it. We're not done yet. One of the things you want to keep your eye on is these defensive sectors. I don't necessarily think you want to put utilities in there right now because of the AI situation. We're grabbing utilities as a part of the whole, AI data center thing, and so they've been kind of co-opted. But healthcare and staples, they're still a part of that flight to safety defensive sectors. And the concern is when you're seeing money rotate into low beta products, low volatility, boring, sleepy, staples, defensives, that's all well and good until they start running away from that. Now, generally, when we rotate out of that, we rotate back into growth, right? We leave the value stuff behind, the boring, slow, sleepy value, and we go back into growth. But if they bail out of that and they don't go into growth, they're getting out of everything. And then that brings us back to what we were talking about the other day. If we don't get sector rotation, we're going to get volatility. So watch if they begin to leave the defensive sectors, but they don't go back into the offensive sectors like consumer discretionary, financials, technology, chips, Mag 7, communications, cloud services, software. And kind of goes without saying, but if you've been around for a while, you'll kind of recognize that gold or precious metals are a hedge against downturns. They're like another flight to safety mechanism. Money will rotate there in times of uncertainty. But keep in mind that if things get really bad, say during COVID, the banks get a margin call just like you or I would, right? If they're over leveraged and they're ahead of their skis and they need to cover their debt, they will sell their gold. This is COVID, right? So if you look at SPY or the Qs in 2020, we started to fall in SPY and the Qs. But look at gold in 2020 in January, it started to rise all the way up until they got that change in structure. But where they got scared or where they got hit by the margin call was right there. This little window right here. That's when they sold their gold because of a margin call. Mid-January, February, into March. And it was massive. It was fast, right? This is a weekly candle. And it moved more than 200 points in a week to the downside. It was really fast. You won't miss it. It'll be like that. So if things continue to get really nasty, that would be another thing to look for, is that they're selling gold. And it won't be this little run like we had yesterday, right? It'll be a significant, massive sell-off. So yesterday we had almost everything down. It was easier just to look at what was up. Today we have a lot of things bouncing. It'd probably be easier just to look at what's down. Airlines are down. A lot of them reported earnings and gave forward outlook. Some of them are changing some policies. Like Southwest Airlines is no longer going to do baggage for free as one of their main selling points. You know, they advertise all the time. Investors like it. So it was down a little bit, and then it already has started to bounce back the other direction because they now have something else that they can monetize. Customers don't seem to like it because, of course, not. Now you've got to, pay for luggage like you do at every other airline. So airlines are down, tariff worries, supply chains, a lot of reasons airlines are down. But with airlines being down, that also means cruise lines are down. And the VIX is down a little bit this morning, but it's still up 23.5% over a 5-day period. So it's still elevated. Bitcoin is leading the way this morning to the upside, but if you go look at Bitcoin, it doesn't look very good, right? We're stuck inside that really big bar. And as we usually end up with when the market gets a really big bar like this, is that most of the market is stuck inside that really big bar. China is already at the edge of that big bar. We gapped up in the K-Web constituents all the way up to yesterday's Globex. Now that doesn't get us to the top of the range because yesterday opened gapped down, but it's a start, and it's going to save it from having to work its way up through all of that trash that we were looking at in the S&P, for an example. Cloud computing, it's just an algo print at this point. We need to flesh that out more, but it's up this morning. Gold miners, silver is up, although it's putting in some dark pool prints. But same thing, that really big bar from yesterday, we're already challenging its high. That's what you're going to want to see in the indexes, in the Mag 7, and anything that you're looking for an upside move, is you have to get through that really big bar from yesterday. If you go back and think about what we were talking about in the ES, the biggest concern right now is that really big bar from yesterday. And if you run it from tip to tail, yesterday's high to yesterday's low, we still have a half back to get through. And it's just a really big bar, right? Put it out on a daily. It's just a really big bar. So when you've got gold and the China group, and they're already at the top of yesterday's big bar, then they've skipped all of that resistance in the middle, the half back and everything else. And they have an opportunity for an inside day breakout and can lead us. The problem is you don't want a market rally based on pot stocks and Bitcoin and the China group. Right? We want the Mag 7 with some chips, cloud computing, that sort of stuff. We do have chips, by the way. Looks like they're stuck around that midpoint. GLD's already got the inside day breakout started. It's outside of yesterday's range. Tech stuck under the half. Pot stocks are up a little bit this morning. That doesn't look really good. Financials, not even back to yesterday's high, stuck in the half. So it's looking like a dead cat bounce at this point. We've got to get the indexes, the Mag 7, through that midpoint of yesterday's range. Get above the half, use that as a starting point, and then get outside of yesterday's high and get above it. Otherwise, watch in the indexes, the S&P, the SPY, SPX, ES, look to reject against that mid and begin moving back down to the downside. We can hold the line. We don't have to sell off more today. But I think it's really unlikely that we get outside of yesterday's range to the upside either. So while I don't think we have to sell off and go lower, I don't think we have to get up there and break out and go higher either. A digestion day at this level would not necessarily be a bad thing. Just holding above 600, trying to heal down here at this level, I think the market would take that. So watch the news. Remember that Trump is scheduled to meet with CEOs, although we didn't get a lot of clarity on time. Maybe the morning session prep will give a little more clarity to that. Nope. All right. Well, they mentioned it in the Europe market wrap. So look for headlines on that too. See if we can get a time frame on it. So watch the headlines, watch the job numbers, and keep your eye on the Mag 7 group. The options flow yesterday afternoon at 3 o'clock was a part of that drive back up. If we're going to continue that drive today, we want to see those options flows coming in nice and early. Another thing to keep your eye on. That's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.